Happy New Year, everybody. Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So as you've probably noticed the last few months, the stock market has been incredibly volatile. October was a pretty bad month. November recovered a little bit, but December was worse than October. At one point, we were seeing on an almost daily basis losses in the 400, 500, 600 point range on the Dow. We also did see the largest single point gain in the Dow in the history of investing. That was over 1,000 points. I think it was like 1,080 points. But most of the volatility has been on the downside. And so that's generated a lot of questions from clients and from others who want to know my opinion on, okay, well, what do I see going forward, Todd? What do I see as the biggest risk for 2019? And that's what I'm going to talk about today. What I see as the biggest risk for 2019, well, it's not earnings, it's not the unemployment rate, it's actually us, you and me, we the people. We're what I see as the biggest risk for 2019, and here's why. So something has changed in the last year, and I'm not sure why, but it does appear to have changed in that many more people seem to be believing things without really checking the underlying data, but they're believing them, because they comport with their deeply held beliefs or their preconceived notions. And I'll give you one example. It's widely believed that when the Federal Reserve did quantitative easing back in 08-09, that money that the Fed printed and gave to the banks, that money was the reason that the economy started to accelerate and that the stock market started to go back up starting in March of 09. And I just don't see the data as supporting that. But as I was watching this panel on CNBC, the host and moderator basically said it was a fact. It was just everybody believes it, I think she said. And one of the people on the panel didn't believe it. He didn't back up why, but I'm going to back up why right now. So if you look at the data for the quantitative easing, you see an incredible spike. This is the first chart I'm going to show you. It shows an incredible spike in the Federal Reserve's balance sheet. I mean, the Federal Reserve was printing money like it was going out of style. Now, you would think that if that money made it into the economy, you would see a spike in the amount of money in the economy. And that's often represented by what's called the money supply or the M2. So here's a chart of the M2 over the same time frame. What you don't see in this chart is the same spike, an incredible increase in the amount of money in the economy. I mean, the Fed printed over $4 trillion, so you'd think that there would have been a huge spike in the money supply. So then you got to ask yourself, okay, well, if it didn't all make it into the money supply, where did it go? And this is what I think many people miss. At the same time, the Federal Reserve did something that they'd never done before, and they said, hey, banks, if you keep excess money on deposit with us, and that's money in excess of the reserve requirements that the Fed puts on banks, if you take your extra money and deposit it with us, we'll pay you interest on it. So I'm going to show you the third chart now, and that's the chart of excess reserves. Those are the reserves in excess of what the Fed requires banks to keep on deposit. And this chart looks a lot like the quantitative easing chart. There was, as soon as the Fed started printing money and giving it to the banks started depositing it back at the Fed and earning interest on it. And that's why the money, it doesn't show up as a huge blip in the money supply, is that the money didn't get into the economy to a great extent. And so what's happened as the Federal Reserve has started to pull that money back? Well, if you look at like the last 12 months of the Federal Reserve's balance sheet and the last 12 months of excess reserves, you see that they fell at about the same rate. So as the Fed was telling the banks, we want some of that money back, the banks weren't taking it out of their deposits and not lending it. They were taking it out of the excess reserves that they'd never lent out in the first place. So, as this host was talking about the fact that the economy is going to slow down as the Fed reduces this quantitative easing money, it's just not supported by the data. The Federal Reserve can pull another $1.5 trillion out of the banks before the banks have to even touch money that equates to their real deposits. All the money that they can take out for the next $1.5 trillion is just excess reserves. It's money they weren't using in the first place. So this is the kind of stuff that as we see things in the media and we hear statements made as fact, I have to basically judge them and reevaluate them to make sure that what they're saying is actually true. Because if there ends up being a fundamental problem in the economy, I need to take action, right? I need to start getting out of equities as we did in 08 and 09, reducing our equity exposure because we don't want to be owning things if the economy is about to tank. But we also don't want to be selling just because we're afraid that the markets might go down because of statements made by pundits that may not be based in actual reality. So that's what I actually see as the biggest risk for 19. It still looks like the unemployment rate's going to be super low for 2019. GDP growth rates are still going to be really good. S&P 500 earnings are still going to be probably pretty good, maybe in the 9 to 11% range, which is really good. It's what it did in 2017. So we're not pessimistic about the economy or the markets. We're just really careful to make sure that the information that we use to make investment decisions is actually real. It's not just somebody's opinion that they think is fact, but may not be based on accurate information. So apologize for the long update, but it's the first one of the year, and it was something really important, so I wanted to get it out to you. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching, and Happy New Year.